Welcome back. As key indicators of where the market is headed, we can only be guided by where it's been. And I just love CoreLogic's Market Indicator Summary for a look at some of the market pulse points. Joining me to walk through some of these is Eliza Owen from CoreLogic. Eliza, let's firstly look at new stock on the market. Now, we've got a graph for you here. If we walk through all these capital cities, it's not uniform. It's not like there's all down or all up, is it? What's going on?
Yeah, so we have seen some different results in terms of listings across the capital cities. Most notably, there is probably over the past 28 days, we've seen about 3,500 new listings come in across the Melbourne market. That's down on the previous measurement period, and it's also down 40% from the new volumes we were seeing coming on in the same period last year. So that's no surprise given the fact that we're now in stage 4 restrictions across Melbourne. The first thing that we noticed around the stage 2 restrictions nationally that were introduced in late March is that the property market responds by seeing a big drop off in new listings. And that's because vendors are quite uncertain about taking their property to market when there's not a lot of movement. There's job loss, there's income loss, and of course, mortgage repayment deferrals have meant that people who aren't confident about selling, even if they're in a more precarious financial position, they don't have to look at selling right now necessarily. So that's where we've seen the big drop off across Melbourne. Where we see lower case numbers and a bit more consumer confidence and higher levels of consumer confidence, that's where we've seen a bit more of an uplift in new listings as vendors have been quite keen to test the market.
And interestingly, we've seen that in Sydney and in Perth, where I think Sydney 13.2%, Perth 9.5% increase in inventory. And let's face it, Sydney has been obviously relatively strong over a number of years, even with a downturn. Perth, however, has had a pretty tough decade. Why do you think that's the case in both of those cities?
Well, I think that so we're measuring against the equivalent period in 2019, and July 2019 was really just the cusp of the next upswing in the property market and was coming off the back of 2 years of quite subdued performance. So new listing stock was quite low then anyway, so in some ways it's not surprising to see that surpass a little bit. Ultimately, though, I think the increase in new listings that we're seeing in those markets is a reflection of vendors just more comfortable testing the market, particularly across WA, where you've got very low case numbers. They're really more in that post-COVID recovery phase now, and you've got a lot of first home buyer grants and incentives, which could be increasing demand and attracting vendors to the market as well.
You know, one of my perennial bugbears, and that is that you've got old or existing listings and you've got new stock all bundled into the same lot of stats. I guess when you've got developers that are finishing apartment buildings or house and land packages, for instance, they've got no option but to actually list it, do they? So I guess in some areas you'll have a consistency of stock levels because of that. Would that be fair?
Yeah, and I think that's probably reflected when you break the data down regionally, but at the capital city level, I think most of the trend is driven by the kind of buyer and vendor attitudes at the time.
So, of course, consumer confidence is so important because vendors won't list if they're not confident, and obviously buyers won't get out there in the market if they're not confident. But there's another marker, isn't there? And that's vendor discounting. And so we've got another graph here to look at that impact. Tell us, what is vendor discounting and why does it matter?
Yeah, so vendor discounting is the median difference that we measure between an advertised listing price and the discount that's given on the property in the final sale price. So it's calculating the differences between those two events, the listing and the sale. The median becomes the representative of what's happening in that space, and we track that over time. The reason we track that is because it can be a good indicator of whether it is a buyer's market, where you tend to see very shallow levels or very low levels of vendor discounting, and a buyer's market where the vendor discounting is larger and vendors are willing to concede more on their final sale price. So what we've seen in the 3 months to March, before the full onset of the pandemic, and the 3 months to July, where we've seen the effects of the pandemic really manifest, is that vendor discounting has become deeper across each of the jurisdictions across Australia, which tells us that even though price declines have been fairly mild, there is a bit of an increase that we will probably see as vendors are willing to let go of their original price expectations. So certainly more discounts being offered, and the market is definitely more of a buyer's market at the moment.
Well, because of course the original asking price is a function of vendor confidence in the first place, isn't it? You know, they're more confident, they're going to pitch it higher. So, and then obviously as confidence wanes, they will start to reduce that in order to get a sale. But it is quite interesting. You know, we can see very clearly, obviously, that sellers are adapting to changing market. Do you think we're going to see further increasing, or does it get to a point where it levels off?
So what's interesting about the early market indicator report is that if you look at the section on capital city home value changes, and you can see there's a graph of the monthly change in the index, is that at the very end, it looks like growth rates were, or declines rather, were starting to stabilize. So that doesn't mean that house prices are stabilizing or plateauing necessarily, but it means that the rate of decline in recent weeks, it hasn't been getting any deeper. But I think that will change. I think that growth rates will start to accelerate a bit and become deeper, and we could see larger price falls around the tapering of fiscal stimulus, which is sort of happening around September, October this year. And of course, the end of mortgage deferral repayments, which we, officially they're ending by the end of March, but we've already seen signs that banks are looking to, or they're sort of advising their clients in some cases, like you might need to evaluate whether you're going to sell or not if your income isn't recovered. So definitely some points where it could trigger a greater level of decline, and we'll be looking out for that early next year.
We'll be back looking at those stock levels then, won't we?
Yes, exactly, exactly.
And what would you class as a normal market indicator for days on market and seller discounting?
Yeah, I mean, it's always dependent on market conditions. So obviously vendor discounting is going to get deeper and days on market will be longer when it's a buyer's market, and then we'll see shorter days on market and shallower vendor discounting when it's a seller's market. So it really just comes back to looking at the long-term averages for those. We know that for so most areas basically.
Is there a tipping point though? Is there a tipping point, a point at which you say, right, at this many days, we know the market's about to go the other direction? Is it that easy?
Not really. I'd say it's more about the trend and measuring the trend over time.